Today in Flex in the City, we talk to John Beck, Senior Vice President and Director of Global Fixed Income for Franklin Templeton London. He talks about the power of long-term perspectives in fixed income investing. All that happening right now in Flex and the City.
Hello, everybody. This is Rachel Treese for Flex and the City. And today I'm absolutely thrilled to be talking to John Beck. I think that's a very famous name. But John is actually the Senior Vice President and Director of Global Fixed Income for Franklin Templeton in London. And so you're actually the first person on Flex in the City, John, from investment management. A big welcome to you.
Thank you very much. I'm surprised I'm the first person from investment to be on the call.
We've had people from Franklin Templeton, people from all over the world on Flex in the City, but investment management is new territory. So we're excited and curious. John, you're based in the city of London, but you weren't always in the city of London, I don't think. So tell us a little bit about your journey and how you came to be doing the job that you're doing.
As you very kindly introduced me, I'm Director of Global Fixed Income, so I'm a bond manager, which, again, actually, I think when I first arrived in the city, which is just after Big Bang in the mid-1980s, fixed income was a very peculiar area. And actually, even for me, I think probably in the mid-1980s, it was a very peculiar area. I had a degree in politics and economics. And actually, I think one of the things that first struck me when I started work was that I had this kind of expectation, well, I've got a degree in this stuff, surely I understand it. And it became very quickly apparent to me that I didn't. And one of the things I really needed to learn, and I learned quite quickly, is that you have a window in which you can ask what you may think are stupid questions. And actually, they're not stupid questions. But if you don't use that window to ask the stupid questions when it's open to you, everyone will assume that you know what you're talking about. And so back in the mid-1980s, when we were all focused on money supply and inflation and monetary aggregates and so on and so forth, I thought, well, obviously I've studied all of this stuff. I know what I'm talking about. And then you realize that you had Fed repos and you had all of the kind of technical stuff that central banks were doing. And unless you actually asked participants what it meant, it was almost like there was a different language. So fixed income, I sort of fell into, to be perfectly honest. I started working for, originally it was a Middle Eastern bank, but it was co-owned by one of the big American banks. And I had therefore the opportunity to go on a training scheme in New York, which was at the time, I think, one of the best training schemes that you could go on. But, from the Middle East, many of the clients there, they were big sovereign wealth funds, institutions, had first really only come into oil money relatively recently, and therefore fixed income for them was an area of security. And so despite probably wanting, as I think many people do on the investment side, equities are obviously a lot more interesting than fixed income, I ended up in the fixed income world and haven't really looked back, to be honest, with a background, as I said, in economics and also in international relations or politics, all of this comes to play. And so, it has actually been a fascinating period. We've seen, obviously, how many crises have I seen? Well, I saw the crash in 1987. I saw the Russian crisis. We had the tequila crisis in Mexico before then. We had the dot-com bubble. We had the 2008 bubble. We've had the ERM or the Euro crisis in 2012. So, they come around and all of them have an impact, obviously, on fixed income valuation. I'm kind of hoping now that I've been at Franklin Templeton for 31 years, that I may not have too many more crises in front of me, but I think that's possibly a little bit naive to make that assumption.
And I'm curious, what's been the most fascinating of all of it?
It's interesting when you talk to economists, they say, well, you're living in such a fascinating time because, we've got, in some cases, negative interest rates. The whole of the German yield curve at one stage was negative. You paid the German government money to look after your money. And this is something that you won't find in an economics textbook. Now, the economists might find that interesting, and certainly it's atypical. The investor, on the other hand, might take a sort of slightly different view on it. And I think that, one has to express a little bit of caution in terms of, where the valuation is of some of the fixed income securities in particular. This notion that, negative absolute yields nominal yields, let alone negative real yields, does mean, I think, that fixed income in particular at the moment, it's extended in its duration. That's how much interest rate sensitivity a bond has. And the Financial Times regularly tells readers, if listeners aren't familiar, that when interest rates fall, the price of the bond goes up. And of course, the inverse will equally apply. So when interest rates go up, the price of the bond will fall. And so where we are at the moment with more interest rate risk implied in financial markets, in fixed income, in government bonds, does pose that greater volatility, price volatility risk to investors. So yes, it's going to be, I think, slightly more challenging going further forward in the next 30 years than it has in the last 30 years. I think the interesting thing equally in terms of some of the bonds, I remember when I first bought them, I remember buying some bonds in France. This is way back in the early 1990s, and they were maturities in 2012 and 2019. And I thought, I'm never going to be working in financial services when those bonds mature. And here I am. Obviously, they've both matured. I think I can confidently say that the UK gilt 2068, I am going to be 104. And whilst I'm confident that the actuarial tables that I'm still going to be around, I think probably at that stage, I'm not going to see that bond, at least professionally, mature.
There we go. So talking about volatility, let's talk about the volatility of human beings. And so, in your career, you've moved from being a technical expert into the role of leadership, and you're leading, some of the people that you'll be leading will be fund managers. How have you evolved as a leader, and what do you stand for?
At Franklin Templeton, we wanted to try to do was identify what we stood for as a brand. Who was our brand? And we were asked to come up with some pictures, and the pictures that I came up with, and this equally partly reflects, I suppose, what I do some of the time outside of the professional side of things, were two pictures of Mo Farah. And one was of him as he was just approaching the line for the Olympic Games in 2012 for the 10,000 meters. And he's got every single muscle, sinew, strengthening to get to the line. The other, equally, with his eyes just totally focused on that finish line. The other was him after the event, when of course he's won, and he's doing the kind of the big smiley face with the mobile hands and whatever. And I think that is, the reason I chose that is that I felt that did encapsulate what I would like at least to be perceived as a leader, which is, we're never going to achieve, I can't run the 10,000 meters as fast as Mo could, even when I was younger. But, it is doing your best. It's basically, making sure that you close the day having done the best that you can and actually being happy with it. And, I think, Mo Farah, for example, not making the Olympic Games this time round, he's disappointed, but he knows that he put everything on the line and he didn't make it. So that, to me, I think is a really important issue. Put everything that you have into what you can do and then be happy with it. And the other thing, the reasons I chose the picture of him doing the Mobot at the end and the big smile is have fun at the same time doing it. Less so now, in particular, as we're kind of talking as we're coming out of lockdown. But we always used to try to avoid the payroll numbers. So the non-farm payroll numbers is the US unemployment numbers that come out once a month. It's always on the first Friday of the month. Typically, bond markets are very sensitive to the growth in employment because it tends to lead to future inflation expectations, and that has an impact on the valuation of bonds. And so there always used to be this kind of lunatic frisson around, what was going on in the markets and what was the expectation of whatever. And we would always try to be out for that number, not to react for that number because, that was a bad decision, but it was also, let's go out and, kind of talk about things at the end of the week so that we can kind of think of, talk outside the office environment about things that we think are important.
Yeah. So being human.
Yes. Yeah.
Absolutely. And so, you talked about growth and fixed income is about growth. And how do you facilitate growth of people in your team?
There are a couple of things. I mean, again, so I run rather less now than I did. I cycle, but and cycling in London, some people might think is slightly crazy. But, in a sense, one of the key things that I've started off by saying, so I've often worked either very senior colleagues or formerly co-directors. I think the important thing there where you have perhaps two named portfolio managers on a big institutional portfolio is exactly that point. Were I to come to an unfortunate end underneath a passing piece of traffic, let's call it like that, I would absolutely be confident that any of my colleagues would be able to, or certainly any of my senior colleagues would be able to pick up with the clients in the full knowledge of how their portfolio is run, how we run their portfolio, and it would be a case of kind of moving on. So I think, first of all, you have to employ people, you have to work with people who challenge you, because obviously they don't want to be, kind of in your shadow for a long period of time. So you have to facilitate that growth. But I think equally it's quite important, and at the top of the chat that we talked about, ask those questions. So one of the things that I really encourage, people who are younger when they're coming into it, and we had some interns in over the summer, and I said, you're going to learn a great deal more by being in the office where we can just have those informal conversations. Ask the questions, because you have got that limited window of opportunity. And the questions that you ask, are not questions that no one has thought of. I mean, again, going back to that original training program that I went on in the States, I remember some of my, co-students, early stage, bank workers, being terrified about asking, the senior vice president of, corporate finance, how the dividend discount model worked. And I thought, well, this is a bit daft. If they were principally the same age as our parents were when we were in our 20s. And, you would ask your parent, if they worked in financial services, could you explain this to me? So why should we be so nervous about asking a colleague? They're not going to bite our heads off. So I think that, equally professional development is very important at the younger age of entry.
And encouraging them to be curious, I think, is what you're saying.
Yes, and so, some of that's formal. So, as I said, to a degree, I'm fortunate that when I joined, I was largely grandfathered from the trials and tribulations of the CFA. But we do encourage our, the Chartered Financial Analyst is unfortunately because it's 3 years of hard work, the rite of passage to go through the investment side of investment management. And we encourage our colleagues to do that and give them study support and actually pay for them to, do the courses and pay their annual fees to do that. So, that's something I think that is, again, part of the kind of development of the team from, bottom up to, those senior members of the team.
Absolutely. So you mentioned parents in that last statement, and you are a parent. You're a parent of 3 children, I understand. Do they know what you do?
I'm trying to set up my daughter has just turned 18, my middle daughter, my middle child. I have 3. So my oldest is 21 and he is in his final year doing structural and civil and structural engineering. He has no interest in financial services, sadly. I'm trying to set up all of the kind of things, she having turned 18, that she could begin to invest in an ISA. And then equally with my youngest, who is 10, I think, she has a reason to say, well, Daddy kind of works in a bank or whatever it is. I'm sort of slightly more disappointed that my older daughter doesn't really understand, exactly what I do. I mean, that said, I think as a scientist, she's similarly a scientist. She and another school friend of hers did pick up a kind of an economics multiple choice that they found at school. And they found it fairly indecipherable. So I'm afraid my children don't fully comprehend the intricacies of dividend discount or time value of money or the shape of risk preference over a yield curve or fiscal deficits and how they form into a global government bond index. So no, some of that, I'm afraid, I've got a little bit of work still to do.
Yeah. So if you were trying to attract young people to join the industry, do you think the industry is actually doing enough to attract young people to the industry?
Well, I think this is kind of twofold. One is, if younger people understand the purpose of investing, then they are more likely to be interested in the industry. So I think that there's a place to start. And unfortunately, I think many of our university students, their first experience isn't actually of investing; it's of a very significant amount of debt. Now, that said, debt is exactly what I do. That is what governments borrow in their government bond markets. They are borrowing in debt markets. So I think, and again, it's the famous phrase that the 8th wonder of the world is the power of compound interest. So I think that it's very important. Now, where we start that, whether, kind of broader financial understanding at school, certainly in terms of kind of the student experience at university. But I think that, then what we are doing, certainly in the workplace environment, and this is a little bit more kind of centralized in government and nudging and, the issues of auto enrolls and pensions and so on and so forth. I think we're moving in the right direction. But I think we still obviously have some way to go to make people understand the purpose of investment in financial services. And the odd thing is that so many of the associations that you have, I mean, I remember when I first started, Wall Street came out, with Gordon Gekko probably in the 1980s. More recently, we've had that BBC program called Industry, which I watched and thought was hilarious. But there was that kind of expectation that you've got 14 telephones and you're flying in on a speedboat and all of this kind of stuff, and then you actually walk into an office and it's a little bit more like a library. And so I think that people do need to gain less of a kind of a dramatized view of what finance is about, and more of a kind of in the weeds. I mean, I think the phrase "doing God's work," which is the Goldman Sachs phrase back in the early part of, it was 2012 or whatever it was, is a little bit, stretching it. But, there is an important role for deferred spending in your later years, which, is really difficult to understand when you're in your 20s, that is the purpose of saving. And, so yes, I think we do need to connect in terms of why saving is important and why there are different forms of saving. That's not only in fixed income, that's in equities, that could be in diversified strategy. And yes, the kids are now very interested in Bitcoin. It has diversification characteristics that if you have a tiny bit of Bitcoin, I probably won't criticize you too much. But I wouldn't put it as a kind of a key part of your investment strategy.
There we go. So when you were a young man, John, was there somebody that really inspired you as a leader of your own career?
I think there are two people. I mean, obviously, so I surprisingly, and again, this will come across as very surprising, particularly if you're younger and listening to this podcast. I've amazingly actually only had two jobs. So my first job was for 3 years, and I left that bank, and I'm eternally grateful for what they did. But I think I realized that I was always going to be perceived as the graduate trainee. No matter how long I stayed there, I was always going to be the graduate trainee. And occasionally you do have to kind of move to find that opportunity. But there was one person there who we referred to as Old King Cole. His name was Peter Cole. He was actually quite cerebral, but, he would kind of sit there and read. I used to remember, at the time, this was in the mid 1980s. So we didn't even have the euro at the time, and there was debate over which currencies were going to join the European exchange rate mechanism. And he said, all I do is read lots of academic research and then tell you to buy the longest dated French bond that you can find. And although that sounds, a little bit of a flippant statement, what really he meant was that assess value. And if you can assess value and kind of stick with it, and once you've got the long-term stuff figured out, then the rest of it will sort itself out. And so actually that's really stuck with me. Occasionally we can be too focused on the near term. I gave that example of kind of the payroll numbers on Friday. One set of payroll numbers are always going to get revised subsequently. GDP is revised, inflation is revised. All of these statistics are revised, and yet we have this kind of attention deficit that we need to react to something immediately. So I think that was a very important learning point for me. And then actually, I have to call out a colleague, sadly, who died last year, but a colleague of mine, Franklin Templeton, for 23 years, who worked in the emerging market world. And of course, you have a lot of volatility within the emerging market world. I don't think he ever kind of thanked me for introducing him to the Indonesian currency crisis in 1997, or the Argentinian problem in 2001, or the Russian crisis in 1998. But actually the one that really kind of came across was the crash in 2008. And, clearly what happened in the financial crisis, the global financial crisis in 2008, was that risk-free assets, US treasuries, German government bonds, gilts, went to the moon. And if you had any risk at all, particularly in the emerging market world, they bombed. They absolutely cratered. And I remember him in one of our investment meetings, which we were having, again on a video conference with our colleagues on the west coast of the state, banging his hand on the table and saying, I don't know which of these are going to, go bust, but this, is a close your eyes and a buying opportunity. It's, you've just got to buy, it's almost like the Sir John Templeton, obviously, who, forms part of the Franklin Templeton name, who basically in the 1930s and during the fallout in equities, then just bought pretty much everything that was value on the basis that the price was wrong. And so I think that both of those are kind of, long-term investment opportunities, but it's also having the courage to, commit. And I guess the flip side to that is not overcommitting so much that, because these crises are going to come along. You can't have so much risk on the table that effectively you get stopped out. You have to have sufficient capacity that when gift horse looks you in the mouth, you have to say, yes, I don't know which of these emerging market sovereigns are going to go bust, but I know that if you buy them all, you are going to make a lot of money. And I think that was a really, and so those are two people who have definitively influenced, I think, how I think.
I'm curious, John, Franklin Templeton, how would you describe the culture of Franklin Templeton to somebody from the outside?
Franklin Templeton is a holding company for many separate investment management groups, of which I represent one. And so I think that, and again, as the asset management industry consolidates, and we've been part of that a couple of years ago, adding Legg Mason to kind of part of our investment group. I would say that it's basically, it has the advantages of all of the benefits of working for a big firm that has the infrastructure, that has the IT, that has the marketing, that has the delivery, but equally affords the flexibility of, to some degree, independence within those separate investment management teams. And so I think that, that is very much how any, kind of big firm will have its advantages. But I think that we balance some of those, sort of big corporate way of doing things. And yes, we are, if you're listening to this, from a European perspective or a UK perspective, we're West Coast based of California. So, there's a different mindset. So again, I kind of come back to the point that says that I think that you very much have to accentuate the positive aspects. And yes, if there are certain things that, you might do things differently, go out for a walk and come back and, think about it again. So yeah, no, I've been here 31 years. So obviously it's a relatively comfortable pair of shoes.
Very good. Diversity and inclusion. I know that Franklin Templeton is really passionate about diversity and inclusion, but how would you say that in your own experience, how that's impacted the performance of the company?
Well, I think the first thing, which I think I kicked off by saying is that, when I first started, I was struck / horrified. My wife's in medicine, and medicine is far better at reflecting, first of all, gender diversity within the population. There are more medical students who are female than there are male medical students, which, actually is how we're born. There are slightly more females born than males. And yet, I think, when we looked originally at the kind of the fixed income universe, it was predominantly male. So I think some of the, we're fortunate within Franklin Templeton that our CEO, Jenny Johnson, obviously is female. I think equally within, the central bank universe, I think, we've made a lot of changes. So the very fact that, we have Janet Yellen as the former chair of the Federal Open, the Fed, Christine Lagarde now as ECB, head, a lot of that I think helps. Now, what have, I done within the team, I think within the group that I have, and, we don't have a strict policy, kind of, if you like, of positive discrimination. But I've always ceteris paribus, and there's an economic term for you, all things being equal. I think if I've got two candidates in front of me and they're of equal ability, I would want to potentially improve the diversity within the team. And I've talked whether that's kind of male, female, whether that's geographic. So, in terms of the nationality of some of the team members that I have, I was visited by one of our American colleagues 5-6 years back, and they came in and said, "You've really got the United Nations you've got the French, you've got the Bulgarians, you have the Italians, you have Spanish, you've got Americans, you've got, I think we had someone from the Cameroon. So, we had a really diverse international team. And I think that, that's beneficial because, it reflects society. And equally, if as a role model, equally, you want to be selling to all of those people if you're simply transactional. So again, a more recent thing that we did this year, I helped support. We had 100 black interns that we as a company supported. I had 3 very bright individuals from, they were largely from King's College London. One of them was a little bit too interested in crypto, but we tried to dissuade him from that. But no, so I think those are very important things, because in order for us to sell to reflective society, we need to be reflective ourselves.
Correct, absolutely. So a bit of a philosophical question. If you had the power to change financial services, and you had the magic wand, what would be the game changer that would really change financial services for you, John?
Well, so I thought about this, and I thought about it equally as I was on my bike, and the bike has a relevance. I was out doing a cycle ride a long time ago, and I was chatting to, as you do in a cycle club, you don't know the people that you're cycling with, and then you kind of chat with them as you're going along. And it turns out this chap was in regulation, and then it kind of went on, and he'd been in Hong Kong, and then he'd come back, and he was at the FCA, and I looked him up afterwards, and he was the former CEO. And one of the things that we kind of chatted about was that we often think of regulators as being the good guys and the bad guys. It's the guys in the black hats and the white hats. It's kind of the ridiculous good cop, bad cop. And I think what we really need to recognize is that regulators are there actually to help us do the right thing. And I think too often I think less so, clearly, I would say within Franklin Templeton, and certainly within institutional client management, where you have very strict guidelines, what you're allowed to do, what you're not allowed to do. But there is still this kind of perception that, financial services operators are a little bit sharp, that they're always out to try to, game the system to, make money. I've made money out of that. No, you haven't actually. You've outperformed an index. And in doing so, you've probably helped a diverse strategy to improve its overall returns, which will be useful for someone's future pension. And I think that if we frame some of those things, not only in terms of less the immediacy of gratification and all of that sort of stuff that is so often pictured within the media, and I think equally we as financial services firms to understand the role of regulators, but work with them. Because at its most simplistic, if you're buying a funeral plan, then the FCA probably is going to make sure that you're not getting ripped off at the time, and that's interest rates, and that's a different type of interest rate to what I'm generally doing. But I think when you work with regulators in a sensible way, then I think that it does make financial services, that power of compound interest and the value of compounding up much more important.
Absolutely. And so my final question, John, you are a cyclist as well as being a dad. You spend some time cycling, I understand, in your free time. Am I correct?
Indeed. Yes. I came to cycling from running, hence the comment about Mo Farah. But I guess as we get old, our marathon times get slower. So it was time to find a new sport. So yes, I'm afraid I am a self-confessed mammal, middle-aged man in Lycra. I had cycled in this morning. Amongst some of the more lunatic cycle things that I've done, I cycled from M to M, from the Manche to the Méditerranée. So I went from Caen to Nice, over Mont Ventoux, which they cycle on the Tour de France. I've gone from Venice to Pisa. Wow. And I was hoping to cycle from one end of Portugal to the other, but that got stopped because of COVID. So yes, I was out last Sunday doing 60 miles out to Brands Hatch on 2 wheels without a motor. It's early starts to try to at least not mess up the whole family weekend, but hopefully it keeps me fit and keeps me sane. And actually, one of the odd things, actually, from a financial services perspective, I remember one of our foreign exchange counterparts who was desperate, again, with this debate between kind of the short term and the long term, and thinking about it. And I think the reason that he had picked up our account was that he really wanted us to be trading with New York outside of London trading hours. And I said to him at the end, I said, you know what, Nick, at the end of all of this, I'm just probably going to run home and think about it. And I do a lot of that now on my bike. So I kind of, of course, it wasn't the answer that he wanted, because, he wanted me to be trading here and now. But actually, I think being out on a bike or being out doing exercise of whatever form gives you that opportunity really to kind of think through the long term, as I talked about. I sit there, read academic papers, and then tell you to buy the longest French bond. It allows you to kind of clear your head and kind of then come to that decision, not in a pressured workplace environment. So yes, I think there is a lot of value in doing that. Plus the fact I've had a free ride to work this morning, so hasn't cost me a penny.
And so my final big question: what can financial services learn from cycling?
Long term, and don't crash.
John Beck, on that note, I'd like to thank you so much for joining us on Flex in the City and sharing your story with us today. Thank you so much.
Thank you.
You just listened to Flex in the City. Catch us